Hello, everyone, and welcome back to Your Finance TV. After a week off on our side, we've got Jay Pelosky back, fresh from his Bloomberg TV show. How are you, Jay?
Good, Scott. Good. Great to see you. It was I missed you last week, and yes, today was actually quite a special day because I was honored to be asked to guest host for an hour on Bloomberg Surveillance with John Farrow, and even more exciting, it was in person. Now, I haven't been in person on Bloomberg since COVID, so 4 years. And I have to say, while I enjoy sparring with John as I do with you, what was really great was the makeup. So I kept it on for you because I thought you would enjoy it. So hopefully you appreciate, I was like, wow, it's as if I never left. They wiped 4 years off my face with a little blush, a little hair filler, and all the rest of it. So fun times. And of course, happy to follow that up with the Your Finance TV session, as we always do here on Fridays.
Well, we know which one your favorite is, but we don't get the makeup for you. You do look very good, though. I feel like I'm a little bit underdressed today. But one of the things you did do on the show, you went back and looked at some of your past musings. Now, obviously, the viewers can go back and look at the library of all the content, and we've dug deeper into these sorts of things. But for the benefit of people who couldn't see Bloomberg TV today, like talk about some of the past musings you did look at.
Yeah, I did exactly that to kind of prep because obviously it was a huge week, right? We had new all-time highs in the US. We had new all-time highs in Japan, 35 years in the making in Japan, right? We had 9 straight up days in China. And of course, we had NVIDIA proving the failure of Wall Street's imagination with its earnings blowout yesterday. So did go back and look at some things, and I started back in early November when we wrote "Fear is Everywhere" back on November 10th, and I have to give myself a bit of a victory lap on that one because we pretty much nailed the bottom in the subsequent rally to this point, up about 20%. And we noted back then the really nice setup where sentiment, seasonality, positioning, and technicals were all super favorable for an up move in the US equity market. And lo and behold, that's what we've gotten. And now those factors are all much less compelling than they were, now 3 months ago. Next up, we talked about the action is elsewhere, a piece we wrote roughly a month ago. I think it was the 26th of January. So just a little bit shy of a month. And there we made the point that it was the U.S. had a big run, and investors should look elsewhere for some laggard opportunities. And lo and behold, as we pointed out this morning on Bloomberg, over the last month, Europe, Japan, and China have all outperformed the S&P. They're all up somewhere between 7 and 10%. In the U.S., even after yesterday's 2% move, the S&P is up about 4%. So looking elsewhere, having a global framework, having a global kind of asset allocation opportunity set is really proving fruitful this year, notwithstanding, again, all the attention on the US, all the attention on tech, all the attention on Magnificent Seven. But hey, guess what? Over the last 4 weeks, most markets, major markets, have outperformed the US. So then 2 weeks ago or 3 weeks ago, we talked about Wall Street's failure of imagination. And we gave 3 examples, right? The first was consensus 2024 US GDP growth of 1.5%. We think it's going to be more like 2.5. The second example was the consensus year-end target for the S&P, 4980. Guess what, people? We're already at 5100, right? And we're not even done with February. So failure of imagination, right? No sense of upside really whatsoever from Wall Street as a consensus. And then the third example we gave was the comparison people were making between NVIDIA and Cisco of 1999-2000 fame, when Cisco rocketed up and then collapsed. And people basically saying that 2024, the Magnificent Seven, is akin to 1999. And just laughingly, wrong-headed. And so, of course, NVIDIA's results yesterday just reinforced that failure of imagination, right? 760%, Scott, year-over-year earnings growth, and a 16% move in a single day for the flagship stock of the AI age. I mean, nothing says more about failure of imagination than a stock like that big moving 16% in a day. So then to finish up, we talked about what we wrote last week, which we did not have a chance to discuss. So I'll spend a minute on that. And that was that piece last week was titled Handoff. And we made the point that the market has executed a very tricky, typically tricky anyway, transition away from depending on rate cuts, right? That was the rationale for the move in the fall, to an earnings-driven, forward-looking stock market. And so we pointed out last week that rates have backed up 40 basis points or more, right? Depending on where you look in the curve, rates are back to where they were in November. And yet stocks are up 20%. And again, not just the US. ACWI, which is all country world, is up 18%. So pretty much in line with the S&P. And so this is a real important point. We eliminated a really important inconsistency over the last couple of weeks, namely this idea that we were going to get 7 rate cuts and 10% earnings growth in 2024. Those two things obviously don't go together, right? If you're going to get 7 rate cuts, it's because the economy is in the crapper. And if you're going to get 10% earnings growth, it's because the economy is doing pretty well. So we eliminated that inconsistency. We've taken out 4 rate cuts, in the bond market at the cost of nothing more than a 2-week pause in the S&P. And that, to me, is really telling about the health and the power that this bull market is demonstrating. We executed a very tricky handoff with absolutely no disruption whatsoever. That's a strong signal.
We usually open the show by going through the title, and I missed that one today, but it's I love the title this week because I think there's a lot of people in the market thinking this. Title of your musings is What's Next? Now, you tell me, what is next?
Well, I'm not claiming to have a crystal ball, but I think the review of some of the things that I just touched on suggests that we've kind of had our finger on the pulse the last couple of months, right? And so that gets us a little worried, right? We're both in the business long enough to know that in this business, when you feel like you've got your finger on the pulse, it's just about to like bite you and tell you, no, in fact, you don't. So, buyer beware, right? But our view is that we expect continued evidence of a early cycle global economic recovery to manifest over the next couple of months. We're really not paying that much attention to rate cuts. That was the Fed is last year's story. It's really not that important in our view this year because we're entering, right, that return to stability that was one of our 4 for 24 macro surprises. We believe we're early cycle. Just this week alone, evidence of the early cycle. Surging Asian exports. Japan, South Korea, Taiwan, all reported year-over-year export growth of between 15 and 20%. You look at the PMI manufacturing data that came out yesterday in the US, stronger than expected. You look at European service PMIs breaking back above 50. And we know that those are all suggesting that we are going to see, in our view, and this is something very few folks are talking about, we believe that a fully employed consumer is leading to solid consumption growth, which is going to lead to an inventory restocking cycle and a manufacturing pickup. So right now, when you look at Europe, which is manufacturing dependent, they're stagnant. If you look at US manufacturing, the ISM manufacturing index hasn't been above 50 in almost 2 years, okay? You look at China manufacturing, PPI deflation. So the surprise is going to be, and the thing that's going to carry us forward here, what's next, is going to be a inventory restocking led global manufacturing upcycle.
You mentioned China there. Now, China might be one of the ones where people are like, well, hang on, Jay, like you haven't been right on China. But maybe it's
Well,
starting
it's been
to
working
China.
lately. It's been working lately, my friend. Remember, 9 up days in a row. KWeb, just as an illustration, I talked about China outperforming the U.S. KWeb, which is where we're have our exposure in our global multi-asset model portfolio that we run for clients. KWeb is up about 12% over the last month. Now, yes, it's still down over 3 months, and yes, we did get positive towards China back in the fall. So we haven't made up all our ground. That's fair criticism, and we accept that. But look, we want to make 2 points. That we talked about the global manufacturing upcycle. So where do we want to be in terms of investment going forward? We want to be in both the leaders and the laggards. So leaders, we want to continue to be involved in U.S. tech. We also want to be in cyclicals and small caps in the U.S. We want to be in European growth, as we've talked about a fair bit over the last couple of months. We continue to be overweight Japan, breaking out into new all-time highs. That move suggests that it's got power behind it. And then we like emerging markets, debt and equity. So not only has China and emerging markets more broadly outperformed the U.S. over the last month, our emerging market local currency debt position and our Asian high yield positions are both outperforming the Barclays Ag. And commodities, funny enough, and this again reinforces is part of what gives us the comfort to make that manufacturing call. Commodities are the best performing asset class year to date, up about 6%. Goldman Sachs commodity index up about 6%, ACWI up about 4%, and the Barclays Ag down about 2%. So within that, we think China is really interesting because people are worried about, wow, all these all-time highs, right? I mean, do I really want to buy at all-time highs? And if you're worried about that, China is where you want to be because they're very far from all-time highs. And there's two factors I want to mention. The first is the psychological, right? China is being called uninvestable. Well, here's a pro tip. Whenever you hear about an uninvestable market, you should seriously consider buying it because that you can't say anything worse about a market. Secondly, you even have the old Economist cover contraindicator at work here, where the Economist put on its cover a couple of weeks ago, President Xi, with the question mark, can President Xi control the markets? Well, yes, of course he can. And he has to the point where we're up 9 days in a row. And how has he done that? He has done that by putting in place a new securities regulator whose nickname, just get this, Scott, this gentleman's nickname is the Butcher of the Brokers because of his prior experience in this space. So you have the Butcher of the Brokers. You have just frozen the trading accounts of the number 4 biggest quant fund in China. So think of that. That's like the SEC telling Citadel it can't trade, or Millennium it can't trade, right?
Yeah.
And it brings to mind the old adage, the old Chinese proverb, kill the chicken to scare the monkeys, right? So the government is not going to let the stock market go down. Full stop. Feel really confident about that.
Yeah,
now, what's the opportunity?
Yeah, drawing a line in the sand.
Yeah. Now, what's the opportunity, though? What are the fundamental facts as an investor beyond Butcher of the Brokers and Chinese proverbs? China sells at 8 times forward earnings, 14% consensus earnings growth for 2024. We know large cap growth managers in China, folks that we've known for years and years. They put out a monthly report on their portfolio. Right now, they suggest that their portfolio has earnings growth of 25% and trades at 14 times 2025. So that is the out year, 14 times 2025 for 25% earnings growth. That is pretty compelling. And when we go back to the four factors that supported the U.S. back in November, sentiment, okay, uninvestable. Seasonality, Lunar New Year seasonality tends to be pretty good. Positioning, UBS just came out with a report saying it's the most extreme underpositioning they have ever reported in terms of where people are relative to China benchmark weight. The lightest ever. And then fourth, technicals, you have guys like Renmac suggesting that their capitulation indicator has been triggered. And another guy we like a lot, John Kovalos at MRA Advisors, has said that he believes China is putting in a meaningful bottom. So last point, and we'll stop here. If you're worried about buying things at the top, KWeb, trading today around $25, can triple before it gets to its 2021 high of $102.
Wow.
So that's, yeah. So you might want to hold on to your NVIDIA and then buy some KWeb because KWeb's got an awful lot of catching up to do. And again, remember what NVIDIA and others are saying. Everyone is going to be involved in AI. So China is going to have now, and we know that the U.S. is blocking China from receiving the highest quality semi chips, but China too is going to have its version, and the companies that are going to benefit from its version are in KWeb. Full stop. So go in there.
So Jay, I've got rugby on the weekend. I'm going to a minor league ice hockey game with the kids. Like, what are you doing? Just sitting back, relaxing for the weekend?
Yeah, I'm actually continuing to take my show on the road. I'm going to be guest lecturing tomorrow at NYU's Stern School of Business. Looking forward to doing that. I do that a couple times a year. So that's Saturday. And then there's a Duke basketball game as well on Saturday afternoon. So I'll be doing a little bit of that. And then my son fences for Duke, and the ACC fencing championships are this weekend out in Notre Dame. So we'll be rooting him on as well. So pretty decent sports weekend myself, buddy.
Well, best of luck with it all, Jay. And we'll be talking to you again next week.
Look forward to it, Scott. Take care, buddy.
And for everyone else out there, good luck investing.